You know that advice to skip the daily latte and invest the difference? Someone following that religiously saves maybe $1,200 a year. Meanwhile, a business owner just wrote off a $60,000 car, a home office, and half their meals, cutting their tax bill by 30 grand. They spent more money and ended up richer. You saved money and stayed exactly where you were. This isn't about tax evasion or some illegal loophole. This is the actual structure of how money works in America. And almost nobody explains why spending can mathematically build more wealth than saving under the right conditions. Here's the thing they don't teach you. When you earn a dollar at your job, you pay tax on it, then you get what's left. When a business owner earns a dollar, they can spend it on certain things first, then pay tax only on what remains. The order of operations is reversed, and that reversal is worth millions of dollars over a lifetime. Let me show you the actual math, because this sounds like rich people nonsense until you see the numbers. You make $60,000 a year as an employee. After federal tax, state tax, Social Security, Medicare, you're taking home maybe $46,000. You decide to be responsible. You save 10%. That's $4,600 tucked away. Good job. Genuinely. Now compare that to someone who makes $60,000 through a business they own. They also want to save or invest $4,600. But before they calculate their taxes, they buy a laptop for work. $2,000. They lease a vehicle used for the business. $12,000 a year. They convert a room to a home office and deduct part of their mortgage interest and utilities. Another $6,000. They travel to a conference and write off the flight and hotel. $3,000. They pay for software subscriptions, a website, some marketing. $4,000. That's $27,000 in deductions. Their taxable income just dropped from $60,000 to $33,000. They pay tax on $33,000, not $60,000. They pocket the difference. Then, with what's left, they invest that $4,600 just like you did. Except they also still have the laptop, the car, the office space, the knowledge from the conference, physical assets and experiences that maintain or grow value. You have $4,600 in an index fund. They have $4,600 in an index fund plus $27,000 worth of things that support their income. And here's the part where it gets genuinely weird. Some of those expenses aren't expenses at all. They're transfers of wealth to themselves. That leased car? After the lease, they might buy it at residual value, having written off the cost the entire time. That home office? It's part of their house, which is likely appreciating. The conference in Austin? They tacked on 2 extra days and saw friends. The meals they deducted as business development? They were going to eat anyway. This is completely legal. Encouraged, actually. The tax code is written to incentivize business investment. If you spend money in ways that theoretically grow the economy, you get to subtract that spending before calculating what you owe. Employees don't get that option. You can't write off your work clothes unless you're buying a literal uniform. You can't deduct your commute. You can't write off the coffee that keeps you awake during meetings. The system is designed with 2 different tracks. One for people who earn, one for people who own. Now, before you think this is just about starting a business, let me complicate it further. Because plenty of business owners still don't get this right. They hear, write it off, and think it means free money. It doesn't. Writing off a $60,000 car doesn't give you $60,000. It reduces your taxable income by $60,000, which saves you maybe $15,000 to $20,000 in taxes, depending on your bracket. You still spent $40,000 more than you saved. The trick is only spending on things that actually generate future income or hold value. The wealthy aren't just spending randomly and calling it business. They're buying assets disguised as expenses. Real estate is the perfect example. You can buy a rental property, deduct the mortgage interest, property tax, repairs, travel to check on it, even depreciation, which is a paper loss that isn't real. The property might be appreciating in value, cash flowing every month, but on paper, you're showing a loss. That loss offsets your other income. You pay less tax on your day job or your business. Meanwhile, the asset grows. You're spending money on mortgage payments and expenses, but unlike spending on rent for yourself, this spending reduces your taxes and builds equity simultaneously. Or take a real example. Someone I know runs a consulting business, makes about $200,000 a year. Sounds like a lot, but after business deductions, their taxable income is closer to $110,000. They write off part of their home, their car lease, travel, meals with clients, health insurance as a business expense, retirement contributions that are also deductible. Their effective tax rate ends up around 18%. Compare that to someone earning $200,000 as a corporate employee. They're paying closer to 32% effective after you include everything. That's a $28,000 difference every single year. Over 20 years, that's over $500,000, and that's before investing the difference. Same income. Completely different wealth outcome. Because one person's spending reduced their taxes more than the other person's income grew. Now here's the part nobody tells you. The thing that makes this whole system feel rigged. You can't just decide to become a business owner and start writing everything off. The IRS isn't stupid. If you're not actually running a legitimate business with profit motive, your deductions get disallowed and you get penalties. You need real revenue, real clients or customers, a real operation. You can't just call yourself a consultant, make $200 and deduct $30,000 in expenses. Well, you can, but you'll get audited into dust. So there's a catch-22. To access the wealth-building power of business deductions, you need a business that makes enough money to justify those deductions. But starting that business requires time, risk, skills, often capital. It's not accessible to someone working 2 jobs to stay afloat. The people who benefit most from this system are people who already have enough cushion to take the risk. This is why wealth compounds in certain families and not others. It's not just about saving more. It's about structuring your income so the government takes less and your spending builds assets. Once you learn this game, you teach it to your kids. They start businesses young. They understand entities, deductions, depreciation. By the time they're 30, they've been optimizing for a decade. Meanwhile, someone who grows up in an employee household learns to get good grades, get a stable job, max out their 401k, and hope for the best. Which isn't bad advice, but it's playing on a different field with different rules and a different ceiling. Let me give you the absolute starkest version of this. 2 people both want to buy a $50,000 car. Person A, an employee, needs to earn about $65,000 in gross income to have $50,000 after taxes to buy that car. Person B, a business owner, buys the car as a business vehicle, writes off $40,000 of it, reduces their tax bill by $12,000, and the net cost to them is $38,000. Person A paid $65,000 in gross earnings for the same car. Person B got for $38,000 in actual cost. That $27,000 difference, if invested every time a major purchase happens over a lifetime, is the difference between retiring comfortable and retiring wealthy. But here's where I'll be honest with you. This doesn't mean you should go start a sketchy side hustle just to write off your existing life. That's a trap. The deductions only make sense if the business itself is profitable or building toward profit. Spending $1 to save 30 cents in taxes still means you spent $1. You're not winning unless that dollar also generates future income or appreciates. The real lesson is this. Wealthy people structure their lives so their necessary spending does double duty. The car they need anyway. Business vehicle, partially deductible. The home they live in anyway. Part of it's a home office or a rental unit. The meals they eat anyway. Business development if there's a legitimate work purpose. The vacations they take anyway. Conferences or property visits with a business angle. They're not spending more than you on life. They're recategorizing the same life through a structure that rewards it. And that structure is ownership. Own a business. Own real estate. Own assets that generate paper losses but real gains. The tax code is written to encourage this. Employees get a standard deduction and a few retirement account options. Owners get an entire toolkit of ways to reduce taxable income while building wealth. So, what do you actually do with this information? If you're early in your career, the move isn't to quit your job and panic start a business. It's to build skills that could become a business. Freelancing, consulting, creating something, even a side income stream. Once that hits $10,000 or $20,000 a year, you can start using business structures, Register an LLC or S Corp. Separate your finances. Start tracking expenses that legitimately support that income. Gradually, you shift from being purely an employee to being partially a business owner. If you're already established, look at whether your skills translate to contract or freelance work. A software engineer employed at a company versus that same engineer contracting through their own company, same work, completely different tax situation. Or invest in real estate, even a single rental property, to access depreciation and expense deductions. The goal isn't to dodge taxes illegally. It's to use the legal system the way it's designed. And it's designed to reward ownership and investment. Remember that person saving $1,200 a year on lattes while the business owner wrote off $60,000. The latte advice isn't wrong. Cutting wasteful spending matters, but it's playing in the margins. The real game is changing how your income is structured so that the spending you're already doing builds wealth instead of just disappearing. This is the actual divide between middle class and wealthy, not just income level, income structure. And once you see it, you can't unsee it. Every expense becomes a question. Is there a way to make this deductible? Every income source becomes a question. Could this flow through a better entity? The system isn't fair, but it's the system, and knowing how it works is the first step to making it work for you instead of against you. If this made you rethink how money actually moves, subscribe. We're explaining the mechanics they don't teach on purpose.